Hello everyone and welcome to the ICRA podcast on Banking Sector Outlook FY2026. My name is Sachin Sachdeva and I am the Vice President and Sector Head Financial Sector Ratings at ICRA. In this podcast, I will walk you through the key regulatory developments which will have bearing on the sector's performance during the year. In addition, I will talk about other parameters including resource raising, asset quality and profitability matrices, while offering a detailed credit analysis to arrive at likely trends in FY 2026. Thank you for tuning in, and let's dive into the ICRA Banking Sector Outlook FY 2026. ICRA has a stable outlook for the banking sector, which is primarily driven by expectations of comfortable profitability, under control asset quality matrices, and sufficient liquidity and capital buffers to meet anticipated growth. ICRA expects the regulatory easing seen in recent months to support credit growth, leading to a forecast of credit expansion of Rs 19 to 20.5 trillion with a growth rate of 10.4 to 11.3% in FY 2026 compared to growth rate of 10.9% in FY 2025. Such measures include the repo rate cut, deferment of proposed changes in the liquidity coverage ratio framework, and additional provisions for infra projects, along with the rollback of increased risk rates on lending to unsecured consumer credit and non-banking financial companies. Besides this, the durable liquidity infusion by the Reserve Bank of India will aid the liquidity and faster transmission of the ongoing cut in policy rates. With an elevated credit to deposit ratio, the competition for deposits would remain intense, which would limit banks' ability to reduce deposit rates, especially on retail deposits. However, the yields would remain under pressure due to the declining rates on external benchmark linked loans and competition from debt capital markets. With expectations of a cumulative 100 basis point cut in repo rates from February 2025 onwards, we expect the net interest margins of the banks to be under pressure in FY 2026. From an asset quality standpoint, ICRA remains watchful with a baseline expectation of an increase in the slippage rate and moderation in recoveries and upgrades, thereby leading to increased credit cost for the sector. The profitability is expected to decrease slightly in FY 2026, with return on assets and return on equity estimated at 1.1 to 1.2% and 12.1 to 13.4% respectively. Nevertheless, these levels are considered sufficient for growth without significant reliance on new capital. The key credit challenges to watch out include the persisting challenges in deposit mobilization and high credit to deposit ratio, limiting banks' ability to cut deposit rates, the rising stress in the unsecured retail and small business loans, global macro developments, including the impact of reciprocal tariffs being levied by the USA on other countries. Our goal is to provide you with in-depth, insightful credit research and analysis. We hope this report serves as a valuable resource for your strategic business and investment decisions. In case you wish to look at more details and see the report in detail, you may log into our website. Thank you.